Hey, welcome to Everyday Economics, the podcast so you understand the economic world going on all around us. Everyday Economics is brought to you by the Center Square Newswire service. I'm Chris Krug, publisher of the Center Square. Orphe Divounguy is my co-host and partner. He's a PhD economist. Today is Monday, March 20th. Today is Monday, March 30th. The month is just blowing by, 2026. And in this episode, we're talking about what the housing market is telling us about the real state of the economy and what it means if you are trying to buy a home right now. Orphe, this is a big data week. We're going to get a fresh read on home prices, retail sales, and of course, we're going to get the March jobs report, and all of it lands in the middle of an oil shock. But before any of that data drops, you wrote in your Everyday Economics column at the Center Square this week that the housing market was already telling us something important. Zillow's January report showed home values falling for a sixth consecutive month, which makes us nearly flat year over year. The 30-year fixed mortgage rate hit 6.43% the week of March 20th, which is the highest it's been since October of last year. And that was before the full run-up in oil pushed Treasury yields even higher. So you track three fundamentals that drive home prices: labor income, household wealth, and mortgage rates. All three of those are moving in the wrong direction, and they're doing so at the same time. How unusual is that, and what does it tell us about where this market is actually headed?
Yeah, I think we need to separate two things, right? So first, this week, we're going to get a lagging Case-Shiller index, right? The Case-Shiller report that's going to come out, which is for January. And in January, I think home values have been declining for 6 consecutive months. Totally normal. It's seasonal, right? The home values kind of ease into the winter. And then you get the spring, and usually in the spring, activity starts to heat up again. Now, everything was going right until the latest shock, right? February 28th, we go to war in the Middle East, and you get a surge in yields and mortgage rates, right? Up until the early February, mortgage rates, the typical mortgage payment was actually down almost 8% on a year-over-year basis. So affordability was actually improving. And the improvement in housing affordability, well, meant that, you mentioned those trackers, you mentioned incomes and mortgage rates, right? Those things were going in the right direction, right? And the improvement in affordability meant that, typically this spring home shopping season would perform better than last year's home shopping season, right? Because things got a little bit more affordable. At the same time, there's more housing inventory to choose from. And so buyers would have more options, more bargaining power, and combined with the improvement in affordability meant that, we were expecting a spring home shopping season that would perform better than last year's. Now, everything has changed. And so I expect the Case-Shiller report to continue to show, right, flat prices year over year, right? And that's one thing. Now, going forward into what we're seeing in the housing market right this minute today, well, it's not looking the same, right? Why? Because roughly a third of the improvement in affordability was erased over the last 2 or 3 weeks, right? As yields and mortgages increased, right? Things get tighter again, and households start to feel the squeeze, right? So when you look at labor income growth in real terms is moving lower. The labor market has basically stalled. Income growth has been pretty flat. And at the same time, inflation has increased, has accelerated. Oil prices have risen. Headline inflation is moving up and is expected to move even higher. Right, we expect inflation to move almost a full percentage point as a result of the oil price shock. Right, so that's going to bring down inflation-adjusted wages. So that the stock market. Look at the stock market. I mean, the S&P 500, longest weekly loss streak since 2022. The Dow entered correction at the end of last week. Right. Not looking good. So financial wealth, another driver of housing activity, is on the way down right now. So that's not good either, right? And of course, I already mentioned mortgage rates moving up. So combination of those factors is just not looking good. going
Well,
forward.
well, I want to zero in on first-time buyers, right? If we're going to kind of really get to what's going on in the housing market, I mean, that's where I think the most optimism lives, right? And I mean, that's where the most enthusiasm certainly is, right? Or should be. Doesn't feel like it's been that way. And so they're in a fundamentally different position than move up buyers or investors. They don't have equity from a previous sale to bring to the table. They're the ones that are most exposed to rates and prices at the same time. For someone trying to buy their first home right now, rates above 6.4%, prices that haven't corrected nearly enough to offer, the rates, in a way that would be appealing. Job openings now below the number of people looking for work. What does the realistic picture look like? Are first-time buyers effectively priced out of this market, or is there something in the data that suggests that a window uh, is there, but people just aren't able to see it?
Yeah, they're stretched. They're still stretched. They're still very much stretched. I think the only good news here is that things are moving in the right direction. They didn't get worse, right? Even with the increase in mortgage rates over the past couple of weeks, mortgage rates are still lower than they were a year ago. So things have moved in the right direction. They're just not as good as they were, at the end of January, early February, where mortgage rates dipped slightly below 6%, right? So yeah, first-time home buyers likely very stretched. Remember, they also tend to be younger than repeat buyers, right? In the sense that they probably have uh, lower income relative to repeat buyers, less financial wealth relative to repeat buyers. So yeah, so it's a group that's very stretched right now, which is why the housing market is still bouncing along the bottom, and we really haven't seen a big resurgence in activity yet.
Yeah. So the story for 2 years now has been that existing homeowners are sitting on 3% or lower mortgages and they won't sell. So the inventory stays tight. So prices stay propped up even in a softening market. Does the current environment do anything to change that dynamic? Like when, you're like layering rising rates and what is, we hope temporary economic uncertainty and an oil shock on top of each other. Is there a scenario where this lock-in effect actually breaks and inventory starts to loosen, or does it possibly get worse from here?
Well, it had started to loosen already. So last year we started to see existing homes coming back on the market, sellers coming back on the market, but but they did so as mortgage rates eased.
Yeah.
Right, the fact that mortgages are moving up again means a higher share of homeowners are going to be sitting on a mortgage rate that's below the prevailing rate. The fact that there's so much uncertainty out there, especially with the labor market, means that fewer people are going to be willing to move, to make a step out and move, right? One of the main reasons people move is a new job, right? So like, you gotta have people staying put, more likely to stay put. The fact that there's so much uncertainty about your future income makes you less likely to go out and take on a new mortgage or even, borrow to buy a new car or just any big ticket item. And so all of that is going to slow down the increase in inventory going into this year. And potentially you have some sellers kind of sitting on the side.
Yeah. So later this week, we're going to get the home prices. We're going to get that data. We're going to get retail sales on Wednesday, and the March job report drops on Friday, on Good Friday, when the markets are closed, which is probably a story in and of itself. All that data is still ahead of what of us from where we're taping this on Monday, March 30th. For the people that are listening and watching who are in the market to buy or thinking about it, when this week's numbers start coming in, what's the one data point that would change your outlook on housing, either for the better or potentially for the worse?
Yeah, I think ultimately you got the labor market is probably the biggest data point that's going to come out this week. Well, it's for the month, right? And a couple of factors, right? First, inflation's rising because of oil price, the oil price shock. At the same time, in the retail sales and labor market numbers, if we see a second consecutive month of declining employment, or even downward revisions to previous months, right? That could be really a deal breaker, right? It will will take confidence. It will cause it will potentially get mortgage rates dropping a little bit because yields and mortgages dropping a little bit because investors will look at this and say, well, this economy is really slowing down and could potentially and demand could be falling at this point, and so you might have this kind of flight to safety that brings yields a little bit lower. I think that yields might be a little too high right now, given the way this economy is evolving. So that is the drop in mortgage rates. On one hand, could be a positive. On the other hand, the fact that the labor market is essentially frozen, and could be at risk of breaking. Essentially, could also keep people on the sidelines, right? So it just doesn't look good, right? If you were hoping for a big rebound in activity in the housing market in 2026, this doesn't look like the year that's going to happen. It looks like a year where you may barely get maybe a modest increase in activity. If not, we're probably just going to match last year's numbers.
Well, thanks as always, Dr. O. Make sure you read Orphe's Everyday Economics column every Monday in the Center Square and across the Center Square Newswire, and listen to what we have to say every weekend on the Center Square Radio Hour.